Hi everyone, welcome to our taster lecture. Just let some more of you come through while your audio is connecting. Please do let me know if you can hear me. That would be awesome, just in the chat button. Thank you very much, I appreciate that. Okay, so welcome everyone to our taster lecture with Pinar, who is a professor of entrepreneurship and innovation at Saïd Business School and serves as the director of the Oxford Future of Finance and Technology. We will be doing questions, so please do put your questions in the Q&A box. If they relate to the spreadsheet, Pinar will just jump in and answer them. But if they're more towards the program or anything like that, then we will do that at the end. Over to you, Pinar.
Thank you very much, good afternoon if you're in the UK, or good morning or good evening. It's a pleasure for me to be here and to talk to you about how data and data-related businesses are transforming industries. This is part of what I do research on. Before I get started on today's taster session, I will give you a bit of background on myself if I can. Let's see if I can move this forward. Yes. So I am originally from Istanbul, Turkey. I was educated at Stanford University in industrial engineering and economics, and then did my master's and PhD in management science. I did quite a bit of work with technology, venture capital in Silicon Valley, and helped entrepreneurs, and was also on the VC side for a while. I did quite a bit of consulting and did consulting. I came to Europe with consulting, and then I was at ESA Business School in Barcelona for a bit, teaching. And then together with my family, we decided to come to the UK a few years ago. And I'm now at Oxford, as you know, professor of entrepreneurship and innovation. What I love to do when I'm not teaching is to do research on technology markets, and the way that I approach finance, although, you know, from today's presentation, it may appear to you like I'm a finance professor, but I'm actually a strategy and entrepreneurship professor. And I look at finance as a setting where technology is disrupting the market. And with that kind of general theme comes, of course, things like understanding what open banking is, which is what we're going to talk about today, how the fintech movement is growing, and what are some of the particular challenges that fintech firms are facing, and what is the role of digital platforms, not just in finance, but across industries. So those are some of the areas that I'm passionate about. All right, so let me move forward now. And 1 second, make sure that I can click. Yep, perfect. Okay, so before we get started, what I'd love to do is to give you an overview of some of the technology trends, which you're probably familiar with, but the way that they fit together actually helps us understand why we're seeing more and more platform businesses in the world. So the first one is that even pre-COVID, even in 2019, 30% of large enterprises were being impacted by business model disruption. And the large majority of this disruption was coming from platform businesses competing in their areas. So this is a huge trend that we see. And as you can imagine, with COVID, this trend has increased quite a bit as businesses had to digitize. And you see in the news every day how the pandemic has helped Jeff Bezos and you know, all of the platform providers, and has not so much helped the classic businesses, right? So part of what we see also is that through digitization, there is an increased connectivity between what used to be traditionally separate businesses. So we start to, as we consume services digitally, we start to understand how they could be connected and how connection actually helps us. This already started many years ago with things like, you know, a little chip in your running shoe that helped connect it to your phone before your phone was capable of counting steps. and all sorts of different devices. So Google is very big in auto manufacturing now, not as an auto manufacturer per se, but as a software provider for autonomous cars. And so we see that digital businesses are able to penetrate across industries into connecting different traditionally separate businesses. What this brings, of course, another trend is that as we create more data, and even in a pandemic environment, even if we're confined to our home, which I am right now, as I get up from this chair, I'll be creating data. How? Because I have a smartwatch. And then I'll be, making a call, and I will be writing down something in my shopping list to then put it in the supermarket delivery order. And all of these data points actually are subject to analysis by various firms. And as customers, we're starting to understand that more data means possibility for better analysis, and therefore we're starting to expect that. If you watch the Social Dilemma movie on Netflix lately, there's a line there which is quite interesting and true, which is that if you're not paying, then you're the product. And in fact, we're starting to realize that, well, if we're not paying for this product, then they're probably using our data. But what can we expect in return? We can expect better service, better prediction, right? So all of these things together, the fact that data is gaining importance, it is helping connect traditional businesses and creating these one-stop shop environments, and traditional businesses getting disrupted are all part of a theme that is within the rise of platform businesses. So platform businesses are everywhere. You can see their effect across industries. So if you compare in this table BMW to Uber, as Tom Goodwin says, Uber actually doesn't own any cars. And they have surpassed BMW, one of the top manufacturers in the world, in market cap. Marriott versus Airbnb. Similarly, Walt Disney versus Facebook, if you think of them as entertainment and content providers, and the list goes on, right? So we can see that traditional businesses are and should be scared of platform businesses. But so far, platform businesses have stayed mostly in areas that are not highly regulated, such as retail. Auto manufacturing was even a little bit later compared to the others, but it started with retail and groceries, and kind of then came the sharing economy, lots of sharing services, skill sharing, car sharing, all of those guys. But regulated industries such as healthcare and education and finance, etc., energy, have actually had stayed rather protected from this platform disruption. However, we see that today this is not true, and that is the topic of my talk with you today. So platforms are overtaking products. You see this if you look at 2006, you see that there's only one platform business in the top 5 firms in terms of revenue, whereas already in 2017, the big tech firms, or the GAFAM firms, have taken that top 5 spots. Platforms are not a new concept. If you are familiar with street markets, this is actually close to where I grew up, and my mother used to take me to a street bazaar like this. I believe it was every Wednesday morning. And what this is really a platform where buyers and sellers meet. That's really as simple as it is. But if that platform then becomes digital, as you see on the right, then there's actually quite a few additional benefits, such as the data being used in order to make the service better, more streamlined, both for buyers and for sellers. Why are they so successful? I have already given part of the answer, but basically the idea is that they reduce transaction costs. What does that mean? It means that it's easier for, in the example of Uber, it's easier for me to find the taxi compared to just waiting on the street and hoping for one to come by, or worse, having to call one and then waiting for it, right? It's also easier for me to pay for it once I'm in it, right? And there's also additional advantages, such as I can make sure that the quality is increased. And the reason, moving forward, the reason for this is because if the quality is not good, then I can rate it. Again, data helps me improve the service, right? And that is one of the reasons why it's actually quite important to understand that platforms grow uniquely and quite fast. The reason why platforms grow so fast is based on what you probably also have heard of as network effects, or in strategy we call network externalities. And this basically means that every single member that joins a network, this doesn't have to be a platform, any network. Imagine that you're a club, that, chess club, right? If you watch Queen's Gambit lately, again on Netflix, you can tell I'm in lockdown because I watch quite a bit of TV at night after the kids go to bed. In Queen's Gambit, for example, the fact that at the final, the match is so exciting actually gets more and more people into chess. And every single person that gets into chess and starts playing makes that chess playing much more valuable for the network, and especially imagine it in a digital environment because there's one more person to play with, right? So network externalities basically means that every single member that joins makes the network more valuable for everyone else. This can happen directly because, as I said, more people are joining, and in WhatsApp, it's a direct effect of, okay, I can reach more of you on WhatsApp if you join. Or it can be indirect in the sense that if I see that more advertisers put their business advertising into Yellow Pages, then as someone who's looking for these services, then I'm more likely to buy a Yellow Pages book into my phone, right? Into my home. And so that's an indirect effect. The fact that sellers are increasing also increases the buyers. The one that's peculiar to digital platforms is the data-driven network effect, which is the fact that as more transactions happen in a platform, more data is being created, and that more data helps the platform make itself better. It improves the algorithm, right? And it actually creates a situation where more and more businesses end up getting disrupted by platforms. Now, let's look at this in a regulated industry. As I said, regulated industries had stayed behind until recently, but we see that healthcare, education, finance, energy are actually getting disrupted by platform businesses. However, this was not necessarily the intention of the regulators. They didn't necessarily invite Amazon and Facebook and Google into finance. This actually happened in a much more intricate way, and that is what I'll tell you today. And I'll give you a few interesting words that you might want to know about open banking and fintech, etc. So my first question here, and I would like you to put very short answers into the chat, is, so I'm guessing most of you have a bank account. And my first question is, how do you access your data if you want to see how much money you have or what you're online? Okay, very good. So on your phone, so there's actually two ways to do that, right? You do it through a bank app, typically. So I'm with HSBC, I have an HSBC account, or I can go to my computer and do it. That's the classic answer. So wonderful, thank you. Now, here is a more interesting question. That data that you see, are you the owner of it? Yeah, you wish, but no. Very good answer, Rishika. Exactly. So interesting. Legally, you are, but practically you are not, because you can't do anything. If I show you a picture on a wall and say, you can look at this picture, but you can't touch it, then you know that's not practically yours. There's nothing you can do with it. You can't use it, right? You can't use that data. And so what this is, in fact, the core of what the new revolutionary open banking regulation does. It basically says that data that you see, you should have access to it, not just to look at, but also for it to be used, for it to be analyzed. That doesn't mean that you can just download it and say, okay, I'm going to run some Excel, calculations on it. It means that you can actually, you will have ways to safely share it with third parties who can offer competing services for you. So let's look at what this means in practice. On the left, you see the situation which I asked you about. So you are the customers on top, and there's proprietary apps of all sorts of banks, HSBC, Bank of America, Commonwealth Bank, etc. Whatever you wanted, it's there. And then it's through proprietary apps and online services that you access that information. However, open banking, and it's called PSD2 in Europe, These regulations actually mandate that it's not just through that proprietary app that you access, which you see on the right, but there's also third-party apps which, upon consent from you, can access that data. How? It happens through what's called APIs, or application programming interfaces. Technical term you don't really need to know, but what that means is that once you give electronic okay, after looking at the third-party app and deciding to trust it, then that data that is in your bank about your payments and transactions, just that data, not your credit or anything else, but just the payments data, can actually be siphoned into a third-party app in order for them to analyze it to give you better services. This is really what open banking is. And it started in UK and EU at the same time, 2015 announcement, 2018 implementation. It's still actually, I mean, as you can imagine, it's still going on in terms of implementation, as EU consists of many states. But in the meantime, it's also started to be rolled out in Australia, Brazil, Canada, India, Mexico, Singapore, Turkey, and the list goes on. US is not part of it, but the Fintech movement is equally strong there, and it's because of the general availability of technology. But open banking makes it easier for fintechs to survive because it gives them direct access to data. So as customers, what does this mean for us? It means that there are many more services that we can consume, and people, meaning third parties, can give us offers. So I can get offers on many different things, such as, you see here, an app. This is an actual app where the name is disguised, but I can actually get loyalty points as I shop. I can donate to charity within the same app. I can look into savings and investment partners. I can look into bill management, credit scores, mortgage, insurance, and there's all sorts of interesting services. And as you can tell, this is like eBay or Amazon, but for finance. Why does this happen? It's because there are just so many services that are available right now through different fintechs that it makes sense. And as consumers, it's very difficult for us to keep track all of these. So combining them on apps and platforms actually starts to make sense. Here are some of the names that are pretty familiar with some of you, at least, because they've been in the news a lot. So Revolut, Starling Bank, Monzo was in the news yesterday because its founder, this guy that you see, is actually leaving the firm because he was burnt out during, not because Monzo isn't doing well, but he was quite burnt out during the academic pandemic. And so he's actually leaving the firm. And there's Atom Bank, and there's just so many of them right now around the world. I've interviewed a few in Australia lately, so there's just a lot of them. And what they do basically is they offer a very simple service, which is just a current account or current and savings account. And they give you a marketplace that has all these providers. Just like Amazon connects you to all these sellers, they connect you to all these different types of apps and providers in order for you to have a one-stop shopping experience on that particular platform. What's the benefit to them? They get that data, right? They know what you're doing, and that's actually very good for them. So what we've done as part of the Oxford Future of Finance and Technology initiative, which is a research initiative, a research center really, is to look into whether these guys are actually doing really well because you see them on the news a lot, or there's any struggles that they're going through. And as you can predict, it's not all a rose garden to be a digital bank or a fintech. So the first thing that we've realized is that these guys are not the Googles and Amazons or the, your well-known brand names, not the British Airways of the world. Their name is much less known. And what this means is that even though people are signing up with them and people actually have these accounts, that doesn't mean that there's actually a lot of money that these guys are getting. Now, let me get a little bit of flavor from you guys. How many of you have signed up with a digital bank, digital-only bank? Monzo, okay, great. Yeah, another, you don't need to give me names. Revolut, Moneybox, yeah? Great. All right, so, But as you can tell already, not a large person. TransferWise is different, right? TransferWise is mostly for transferring money. So it's not a digital bank per se, but it's in that going there, because typically they start with one service, either international transfers or lending or something else, but then they start to add services and they work towards a banking license. But what's also true is that although people are curious and they're signing up, the percentage of people who put their life savings or they put their salary into it are actually quite limited. And as Rishika, as you say, it's because of limited trust. I don't know this firm. And in strategy, we call this, if you're a new firm in a market, you have a liability of newness. So your name, there's less awareness about your firm, and there's also less trust in general. However, in banking, this problem is multiplied because we are talking about sensitive data and sensitive assets. Like financial assets are always one of the first things that people are afraid of losing. And so the situation is that these firms actually have quite a few subscribers, but they have low ARPU, which means average revenue per user. What does that mean? It means they can't break even, right? They don't have enough money to actually fuel services to keep growing. And a little bit like Uber, they're actually running on investor money, hoping to break even. But in order to break even, they need to scale up. And scaling up is very difficult when people are not giving you their money. And as you can imagine, the pandemic has not helped that situation greatly because people are much more wary of trying new things. So another problem that we see is that in order to differentiate yourself, imagine that you're a new bank and there's, for example, in the UK, there's 9 large banks that you need to compete with. You need to get customers from these guys. How do you do that? You do it through a better user interface. You want people to feel that this is different. And one of the banks that I've showed you actually has a policy to talk to you in a very youthful way. And they realized that they actually turned off certain customers because of this, and like lots of emojis, etc. User interface needs to be very clean, it needs to be fun, it needs to be easy to use, etc. However, user interface, this is not just a fashion app, right? User interface is not everything. There's also a very big backstage infrastructure, and you need to power transactions, which is quite expensive. And what this means is that if you spend your money on user interface, and if you actually cut corners either in the back, or if you rely on third parties, then you end up having system failures, which is what you see at the bottom of this slide. Some of UK's hottest fintech firms, this is a headline from a newspaper, some of UK's hottest fintech firms went down, including Monzo and Revolut. What happens when your digital bank, which you're trying out without leaving your other bank, what happens when when their system goes down for an entire weekend? How do you feel? Not thrilled, yeah, panicky. Imagine that had become your only bank, that you had switched completely. You have no access to your money, you can't spend it, right? You're completely lost. And unfortunately, these things happen over weekends. Why? Because data migration, as well as data cleaning services happen on weekends. And that's exactly when something goes wrong. And when that goes wrong, of course, people who are out and about, in the previous pre-pandemic world, and if you have gone somewhere, suddenly you're completely stuck. And that actually really exacerbates the situation of customers' trust. It makes it much worse. All right. Some of the solutions that these guys have found are to grow internationally, because in strategy, what we say is that if you cannot have a margin business, so if you can't make lots of money from one customer, which is what I've told you before, low revenue, average revenue per user, then you should try to get lots of customers and make a bit of money from every one of them. In order to do this, they'd like to go international, right? That's why you see all these. Monzo is eyeing US, Australian fintech is eyeing Singapore, everybody's eyeing some other country, right? And this is the reason they need to break even. However, The problem is that this is not very easy to do because a lot of these services that you're providing are actually subject to local regulations. So imagine that you're providing savings accounts and you're providing investment services, etc. Even if you're not providing this yourself, but you're actually connected with a fintech that's providing that, then you need to make sure that that fintech works in Germany if you're in the UK, and that is not the case. And unfortunately, with Brexit, now it's going to be less and less the case. And so what's very difficult to do if you're a platform in finance is to internationalize, because your products, lots of your products are highly dependent on local regulation. So that actually didn't go too well. And many of these banks are not international yet, truly international yet. And so another solution that they found is the second point that you see in front of here, which is to say, okay, if I can't get lots of customers this way, then let me pivot. Pivoting is very common for startups. Let me pivot to a B2B position. And who do I go to? I go to a big bank and I provide some services, some cool services, AI-based services that the bank doesn't provide yet. The problem is that the bank is not going to let you grow. So the bank already provides lending. They're not going to let you do lending. You're just going to be analyzing the data that comes from the bank, which means that you're a back-end supplier to a bank and with limited abilities to grow. A lot of them then want to get bought up by the bank and exit, because there's no other way. So this is some of the research that we found. Now, let me tell you a little bit about how the big banks are responding to this situation. I put a castle here, which is actually close to me, to where I live here. But the idea of the bank being a secure castle is actually very common. That's one of the first things that people think about when you think about banks. Secure, hard to penetrate, there's an interesting statistic actually, at 90% of us over 90% of us feel that our money is secure in banks, but over 90% of us, again, don't feel that the bank is watching out for our best interest. So we care and we stay with our bank because our money is secured in, and we're afraid to switch because what if something goes wrong? However, we don't think that we're getting a good deal. All right. So in that sense, the fintech movement is valuable to us, but as customers, we don't trust it just yet. Now, some of the things that we found out from talking to big banks, how are they handling this open banking situation, and are they able to innovate and collaborate with fintechs in order to offer better services? First of all, their data is not ready for it. Their data not ready for it means that their data about mortgages, their data about savings accounts and investments are all in different silos, because these services were created in different decades. So they were written in different code. And there's actually very little ability in a bank to look at someone's data across these different services. And that is a big problem. And of course, when your data is like that, then you're going to organize your organizational structure to actually reflect that. So people are also, there's head of mortgages, there's head of credits, there's head of international transfers, etc. And these guys are all profit maximizing, but not necessarily talking to one another. And so there's, in general, this picture of data and being afraid of data is quite common. Banks have the data for millions of customers, but they're afraid to use it. And in fact, one of our informants described it as seeing data as biohazardous waste. You need to contain it. You cannot open that box because you could get fined big money if you actually get that out of the box and if something happens to it, right? It's that kind of fear. And then the second thing is, of course, that they also don't want to share the customer. If I've been an HSBC customer for 10 years, then why is it that HSBC should share that relationship with a fintech? But that fintech wants to be recognized, right? Otherwise, how are they going to ever survive in the market? So another interesting quote that I heard in the market when I spoke to fintechs is that they don't want the bank app to look like NASCAR with all the other logos. They want it to just have one logo, which is, whatever that big bank is. And so these are some of the ways in which these guys are struggling. So let me stop for a second to get to Vipav's question, and then I'm going to wrap up to what this means for the industry. All right. So The future of challenger banks, do you think they'll be able to achieve sufficient scale to be profitable, or most of them will eventually run out of investor money? Good question. So there are several options. A lot of them are trying to scale up, because obviously that's, as an entrepreneur, you wanna be global, you wanna be a success story. Some of them are realizing that they're actually going to end up being bought by someone. And there are all these potential buyers out there, right? You know, it's much easier for HSBC to buy a digital bank and then just put the HSBC name on it, and then get millennials to sign up with that, and then keep the older customers like me with the regular HSBC app. And then over time, people either migrate, they get migrated, or, you know, the old HSBC dies and the new guys actually increase. So that's one option. Another interesting one, which is going to be my next topic here, is that these guys actually want to be the financial representative of a big platform or another large company that we all know too well. So this could be what? Amazon, Google. This could be, it could be McKinsey, it could be Accenture, right? You know, depending on who the target customer is, a well-known brand that now has the ability to come into finance because of the open banking regulation is actually fair game to them. So that's another possibility. Personally, I don't think that many of them will make it, only a few, also because of the dynamics that I explained to you at the beginning. The more people join Monzo, the more obviously data Monzo has in order to make their services better. Same for Starling, etc. However, you know, if you are part of the MBA, then you'll also get to hear from me how these digital banks also have different strategies. So some of them are targeting certain customer segments. Some of them are going after business customers a lot sooner than the others. Some of them are trying to offer lending. And this is something that we would look at then together, right? All right, so let's wrap up and see what all of this means for the future of finance. What you see here is a comparison of what I've told you. So on the left up, you see entrepreneurial new entrants. These are the Monzos and Starlings of the world. And what they do with the Sun, these are the advantages. They can provide cheaper, more user-friendly services. That's really what they're good at, because they're digital born. They understand how to do the online business. However, they lack customer trust. They can't get their system to be resilient because they don't have the funds for it. And international growth as a solution is difficult because they're dependent on local regulations. On the other hand, we have the incumbents. And the incumbents are actually quite good at many things that the fintechs are not good at. So they have the trusted brand, they have the resources to build this resilient system, they have the international experience, they are already spread worldwide. However, their IT is in silos. It's very difficult for them to use their data because data is actually not readable across different services and across different regions. And they also have, based on that, they have cultural silos, and they're also afraid of getting fined by regulators. So if these were the two types of players that existed in the world, then we could say, the picture will probably not change too much. You know, banks will probably not innovate very much because it's very difficult for them, but these new guys on the left are not going to be able to grow very much either. So, you know, we expect little competition in the market. However, there is another type of player that could come in, right? It doesn't have to be an entrepreneurial new entrant. It can be a new entrant with an existing brand name and preferably an existing platform. What are the advantages of these guys? They have the trusted brand, depending on what this is. So for example, I consolidate all of my mail in Gmail. That means that I trust Google to a great extent. I do most of my shopping at Amazon, which means that I am okay with Amazon knowing almost anything about even my mood based on what I shop for, right? So they also have the resources. They are digital born, so they understand the platform business. And because there's already so many different fintechs in the world, they don't have to make anything themselves. They can just buy it and put it onto their platform. Imagine Amazon extending itself to offer financial services based on either the purchases you make, or if you're a seller, then giving you a bit of a business loan to get started. And in fact, that's what's happening today. If you look in the middle, Amazon is already giving loans to small to medium businesses in order to increase the number of complementers, number of providers on its system. on the upper left, you see that Google is actually has committed to providing bank accounts in the US in 2021. So this year, by the end of this year, they said. We see that Facebook is actually doing something quite different. Now, keep in mind that these platforms are not all identical. They have different resources and capabilities, and therefore different competitive advantages. And if you were to get into the MBA, then you would actually look into how these guys are different, and based on that, what kind of services we can expect from them in different markets. Facebook, as you can imagine, because they're a social media platform, they are actually really attacking the peer-to-peer payments. Peer-to-peer payments may not mean much to you, but they actually mean quite a bit depending on where in the world you are, because in some parts of the world, large percentages of the population don't have a bank account, but they do have a Facebook account. And so it's important for these guys to have a way to easily pay one another. And that's actually great for Facebook, because not only does Facebook then get commission, just like in mobile payments, but they also get the data, which is what they're after. And then Apple is a classic one. They have a credit card, and they're much more of a your data is secure with us, and we're not after your data kind of platform. And because of this strategy, which has been there for many decades, then they're doing much more classic things such as Apple credit card. All right. So overall, what we see is that platform disruption is happening. I've just put in a few examples for you here. That show that it's not just in finance that we see this. And part of my current research, which is hopefully getting published this year, is looking into how these firms, the platforms, are disrupting healthcare. And they're just as a maybe nugget of information there, the way that they come in is they come in as an IT provider. And then as they get access to the data, they start to lure in healthcare providers through AI diagnostic services, because diagnostics in healthcare can really save millions of dollars and pounds, right? So that's how they do it. And then, especially in the pandemic, the use of platforms for education has increased. But even before, Google has been quite smart by giving away free Chromebooks into classrooms everywhere in the world. Obviously not literally everywhere, but in places that you wouldn't expect, such as South America and Africa, etc. And the reason for this is to make sure that they have educational data, which then they can expand by providing educational tools and really capturing that market as well. And here on the very right, you see that Amazon is increasing its retail platform they purchased a company called PillPack, which allows them with their license to also offer pharmacy services online. All right. So these are some of the things that we see. And overall, what we can tell is that although regulators were trying to make the market more competitive by saying, okay, data doesn't belong to your bank, it belongs to you, so you should share it with whoever you want, democratization of banking, blah, blah. But actually, what's happening is because of the characteristics of this industry, startups are finding it difficult to survive in there, and platforms are finding it very easy to come in now with the new regulations, which is actually, I recently talked to the head of open banking in the UK, a regulator, and what he told me was quite interesting. He said, what keeps me up at night is Amazon, not a small fintech startup. It's really Amazon and Google, right? So, and this is kind of very much in line with what the observations from the market tell us. What this also means is that the fact that you're so big in the market, that you're a big bank, doesn't mean that you actually will be able to survive this. And what we will see probably is that more and more platforms are going to take away, other new businesses are going to take away financial services that make sense for them to offer. And that means that what we understand as a bank with all those services is actually going to change quite a bit in the future, because we'll start to shop from different places, because it will be much more economic for us to do so. And what this research also shows you is that collaboration is not always a rose garden. Even if a fintech and a bank want to work together, IT can get in the way, interesting, and not just culture of big guys versus small guys, which is a typical thing that you find in books, but IT issues are actually quite important and they can get in the way of a collaboration in the digital age. All right. So this is where I will wrap up. I post a lot of stuff on this and I interpret current news like, fintechs being bought or not being bought or antitrust regulations, etc. So feel free to follow me. And this is also where I open it up to more questions. Thank you. Feel free to put your questions in chat and we'll answer them basically to the extent that time allows.
There's a few questions in the Q&A box. Just
what I see as the last question is Vipav question, which I've answered. I don't see any other questions. It could be 1 second. Oh, okay. Okay, so there's a different box. Sorry, I had not seen that box. That's great. So I'll start with Rishika's question, which starts first. Have we seen the tech giants disrupting the B2B market, targeting B2B customers, or the likes of Facebook are focusing mostly on the B2C? Very interesting. So as you know, a lot of these platforms are particularly in the B2C, and that's where we see their financial services being offered. However, a few of them that are already providing IT services to large firms are, such as banks, are already also looking into providing more and more to these guys. So for example, Google, right? Google Cloud and Amazon Cloud are actually some of the services that are becoming more and more popular. And I'm currently working on a piece where we look into whether banks should go on cloud services, any bank should do this, and who they should partner with, etc. But yeah, so there's a bit of that happening, but in the real disruption, the real, okay, I'm going to replace the bank is really happening in the B2C space, obviously, because if you are providing B2B to a bank, then you want the bank to survive. But in B2C, you don't want the bank to survive. So there's a bit of a dilemma between the two as well. It's mostly B2C. All right, so do regulations exist between sectors? For example, if a powerful player like Amazon controls health tech data and fintech data, can't exactly. So this is part of what's happening with antitrust regulations, right? This is the situation is that yes, so Facebook, for example, can Facebook integrate data from WhatsApp? Can it integrate payment data with social media data? In the absence of regulations, yes, they can. And that's why frantically the EU as well as US regulators are actually trying to figure out how to regulate these guys. And that's really the essence of why the idea of breaking them up really also occurred, right? Because if you don't break them up, then how are you going to make sure that they cannot share this data and cross-pollinate the data in order to offer better services and basically become unstoppable? So that is the big theme of today. And I'm currently developing a course actually, which is called Digital Platform Disruption. And the last module of that course is really dedicated to antitrust and ethics and how the world is moving into living with digital platforms rather than kind of being disrupted by it. Okay. So Mary, what are your views on future regulations that will be introduced to regulate the fintech space? How soon and how strong would these be, and how would these impact the fintech startup industry? So open banking, and by the way, I should say that open banking is not the only regulation that the type of regulation that you could have in order to allow fintechs to come into the market. There's versions of that. So for example, Australia has what's called an open finance regulation. That means that the data that is accessible is not just payments and transaction data, but it's also other types of financial data. So it's much more broad, which means that many more different kinds of firms can enter the market because there's access to existing data. There's also another version of it, which again, Australia has said that they want to go towards, but it's a lot more work, which is called open data. And that means that it's not just within finance, but across sectors. And the idea is that we use APIs, again, application programming interfaces, in order to make sure that energy data, finance data, healthcare data, education data actually becomes accessible. But of course, it creates a nightmare in terms of how do you secure this data, and who can access this data, and what kind of advantages will the keepers of that data get, etc. There's dilemmas, because if you as a state, if you centralize that data, then that starts to get into a big brother kind of situation. But if that data is fragmented and in the possession of different parties, then other problems arise, such as unevenness in competition. So I wouldn't want to be a regulator right now. There's actually quite a challenging task ahead, but they need to go through it. And they will probably get it wrong a few times, but then every single regulation will go towards kind of regulating these guys to make sure that other businesses can survive and have a chance, because otherwise we would go into a situation where the world consists of platforms and nothing else, really.
That's great. And we have one more question here.
Yeah.
When e-com companies who have their own e-payment channels start applying for digital banking licenses, what is their end goal? Is it to collect more data and improve services?
Let me see. Interestingly, that's not the question that I see, Sarah. I see
if you go to
Zach.
Oh, you do? I've got one here. Sorry, I clicked answered, but it hadn't been answered.
Oh, I see. That's probably why I don't see it.
Yeah.
Okay, so I'll answer Zach's question first, and then if the other one appears, then I can also answer that. So
Great.
have you researched new cryptographic platforms such as Ethereum, whose technological underpinnings promise to allow individuals to keep full ownership of data in code versus law? Do you think regulators recognize? So the short answer, Zach, is no, I have not started to do research in cryptographic platforms. And there's one of the interesting new news for Oxford is that we were talking to Ripple for a bit about kind of doing a research study together, but then we had to halt it because they were just sued for lots of money from the SEC in the US. And so we're kind of an interesting situation where we're kind of pausing the conversation to see what will happen. So let's see. And let's see. So I have Vinohars. I think this may be the question that Sarah was mentioning. When e-commerce companies who have their own e-payment channels, e-wallets, start applying for digital banking licenses, what is their end goal? Is it to collect more data and improve services? So basically, yes. The idea is that imagine if you have an e-payment service, it makes sense for you to start to offer more. And we will see all sorts of interesting companies that have your data or that are part of your life in some way to start to offer financial services on top of that. Classic example, airlines are starting to apply for banking licenses. And the easiest way for them to do this is actually to cooperate with a digital bank like Monzo or Starling and say, okay, British Airways checking account powered by Monzo, etc. So we see examples of this in the world already. And if you're already an e-payments company, or if you have payments integrated into your service, then depending on how much upside you have in this, you might apply for a license or not. But again, if I were in their shoes, I would think twice and see, okay, if there are all these digital banks, then why don't I just partner with them? And because these partners, as I've said, B2B is a big business for them because they can't really grow very fast in B2C. So therefore, this is what they'll probably go for. All right, so we have another question with Zihao. Do you think there's a possibility where the traditional banks can compete with big techs in IT, database, open digital banking? What should be their strategies in this battle? Very good question. So what can banks provide? If we are in a world where Amazon and Facebook and Google are going after the same retail customer, meaning you and me, individuals, then banks cannot expect to not lose any customers, right? So because it will be these services provided by Amazon and Google will probably be better and more streamlined, etc. However, if you think about, aside from cloud services, these platforms typically target B2C markets, right? Retail and kind of communications, etc. But the largest majority of their revenue comes from individuals rather than from firms. What this means is that providing services to businesses is something that banks can keep going. Imagine IBM in the 90s. All the PC clones started to come into the market, and IBM started to lose money in the B2C market. They exited, they sold their PC business, manufacturing business, and what did they become? A business solutions company. Why? Because those competitors didn't have the scale, nor did they have the interest to go after companies. So IBM actually focused on business solutions and consulting services. And similarly, the banks that I talk to, they are hopeful of their future in corporate banking, right? They think that that's going to go on for a long while, whereas in B2C, they expect more disruptions. And I agree. I think that it's very difficult for them to compete in that market. However, as you've seen some examples of around the world, like Bo and a few other digital banks, they also are starting to open up digital banks that have a different name, but they are part of the same big bank in order to lure millennials in, because they realize that their old boring bank is actually not making it for the new generations. So I think banks will survive. They probably will change what they do, but they will provide basic services and also, for example, background infrastructure services in B2C, as well as lots of B2B corporate banking services. So that's probably kind of what I think would happen in banking. And again, this is not going to happen tomorrow, but more and more we see it. And every day, watch out for platform news in finance, as well as in healthcare and education, right? And energy. Energy is actually something that we don't hear much about, that disruption in energy is also going to be big. Yeah. So, Sarah, I don't see any more questions.
Yeah, I think that's it. Thank you everyone for your questions. That was really awesome. And thank you, Pinar. That was a really informative and insightful webinar. I really appreciate your time as well. Thank you, everyone. And if you do have any questions that you wanted to forward on to Pinar, please feel free to email me. That's absolutely fine. And she also gave her touch point as well.
Yes.
Have a good morning if it's morning for you, or a good evening. And yeah, goodbye for now. Thank you ever so much.
Thank you, and hope to see many of you physically in Oxford in the future. Thanks.
Thank you.